Between April 2006 and September 2007, the stock market returned about 15%. Gold prices during that period saw the exact same performance of around 15%. Then within a couple of months, by October of 2007, gold began to outperform the S&P 500 significantly, leading to a 33% return between April 2006 and October 2007 for gold, while the S&P 500 stayed at 15%. Many people believe that this was gold's way of signaling that the economy was going to weaken looking forward. When gold outperforms other assets, it means investors are seeking safety. This was then, of course, followed by one of the worst economic downturns in history, where the stock market collapsed by over 50%, while gold retained its value and even continued to rise. Fast forward to today, and we see that between November of 2021 and March of 2024, the stock market returned about 15%. Gold during this period also returned about 15%. But just over the last couple of months, we've seen gold outperform the S&P 500 significantly, returning around 30% since November of 2021, while the S&P 500 stays at a 15% return. Are we seeing the same flight to safety that we saw in October of 2007 today? And we should regard this outperformance in gold as a big warning signal for the economy. Well, when we look at something called the Dow to gold ratio, which is basically the stock market's price divided by gold's price, we get a chart that looks like this. And just last month, in April of 2024, this Dow to gold ratio made the lowest close in over a year. This is something we also saw in October of 2007, where the Dow to gold made its lowest close in over a year, right before the onset of the Great Recession. In fact, seeing the Dow to gold decline before a recession is something that we've seen occur many times throughout history, like here before these three recessions in the 1970s, like here before the 2001 recession, or even before the COVID-19 recession. So is that actually what's happening today? Is this move down in the Dow to gold ratio comparable to what we witnessed in all of these instances and signaling that we're on the verge of a recession? Well, firstly, even if we are about to go into a recession, it doesn't mean that we're necessarily going to see the same type of move that we saw during the financial crisis or what we saw during the 1970s. You can see there's plenty of recessions that caused just short periods of underperformance in stocks, but over the long run, the stock market continued to move higher than gold. So the question is not just whether this is signaling that we're about to see a recession, but also whether we're about to go into another period of significant underperformance for stocks, just like we witnessed between 1970 and 1980, and like we witnessed between 2000 and 2010. These types of large drops in the Dow to gold ratio only occurred during very difficult economic periods. If we add a chart of long-term real US economic growth on this chart, we see it's very much correlated to the Dow to gold ratio. In fact, the ratio predicts what economic growth is going to look like over the next 10 years. You can see this drop in the Dow to gold ratio predicted that economic growth was going to slow down significantly in the mid-1970s. This drop in the ratio predicted the economic downturns that occurred in 1979 and 1982. And again, between 2000 and 2005, the Dow to gold ratio signaled that economic growth was going to slow down substantially. But it also works the other way. In 1995, the Dow to gold ratio surged, predicting that the US economy was going to see a period of strength in the late 1990s. Why does this even work? Because gold is an asset that has zero yield, meaning investors don't get any return for owning it. So it doesn't really make sense to own gold unless you think other assets like real estate, stocks, and bonds have an elevated risk of going down. And usually these things go down when the economy isn't doing too well. Of course, the opposite is true. If investors think there's going to be lots of growth in the future, well, they're going to be buying stocks and bidding up the price of the stock market. And weirdly, that's kind of where we are today as well. If you take a look at the stock market's PE ratio, it's one of the most elevated levels in history. Now, this is something we take a look at often because it gives you the price of the S&P 500 relative to the earnings of the companies within the S&P 500. So essentially giving you how expensive is the market relative to the money that these companies are making. And usually when this PE ratio is very elevated, it means that investors are very optimistic about the future earnings of the S&P 500, which really only happens during moments when the economy is doing really well, like in the late 1990s, in the late 1960s, and in the late 1920s. Even 2021 was a moment when the economy was doing quite well. In fact, when you look at the S&P 500's PE ratio against the Dow to gold ratio, it's almost a perfect match, which makes sense as the economy is getting stronger and investors are willing to pay more for S&P 500 earnings. They're less interested in gold. When these investors are less optimistic on earnings, they're much more interested in being invested in gold. And typically it's when the market is at these expensive levels like we have today that you actually do see the economy head into very difficult economic periods like the 1930s, the 1970s, and the early 2000s. So many use these expensive valuations to argue that we are bound to see a secular period of stagnation, just like in these instances. But the reality is that markets have been this expensive since 2017. So it's been 5 years since the stock market has been hovering around these expensive levels. Why would that change now? That's where the Dow to gold ratio is sending an interesting signal today. You can see it's been going down over the last couple of months, while S&P 500 PE ratios have still been rising. These types of divergences are quite rare, but we have seen them before. We saw this happen once in the 1970s, where the Dow to gold ratio was plummeting, but S&P 500 PE ratios during that period were rising. Eventually, stock market valuations turned back around. We had the opposite happen in the early 1980s, where the Dow to gold ratio was rising, while S&P 500 PE ratios were falling. August of 1982 was arguably the best moment to be buying stocks ever, as PE ratios quickly snapped back up to what gold was suggesting. So that does perhaps put the stock market in a dangerous position today. But for now, this divergence remains quite reasonable. In these instances, the divergences not only were significant, but lasted around 2 years. Today, the divergence we're seeing really began in November of 2022, which was a year and a half ago. This is one of the big things that we're watching for our equity strategy at gameoftrades.net. If this divergence widens over the next few months, it could lead to one of the most fantastic selling opportunities for stock market investors. On the other hand, if we see this ratio climb back up and break out above this key downtrend line that you see here, that would actually look a lot like what happened in 1995, which signaled a huge period of economic strength in the years ahead. Now, all of this is very long-term stuff. In the short term, we've been quite optimistic on the market as it tested this key trendline support, and many of the bets that we added to our list of active trades have been performing quite well over the last couple of weeks. There could be a little bit more volatility, but in general, our bias over the next few months on the S&P 500 is to the upside. You can test our service out completely for free if you're interested in following our trading and investment strategies.